Recently, we featured the most popular stock on Morningstar.ca in 2023, TD Bank. The bank took the spotlight in the sector with a great dividend and lower exposure to a leveraged housing market. Should RBC be concerned? They're still number one in the sector with the largest amount of assets under management among Canadian banks. However, that includes one of the largest exposures to our housing market. Equity analyst Michael Miller says that mortgage debt levels in Canada have consistently increased for more than a decade now, and he sees the state of leverage among Canadian consumers as a risk. That said, there's risk, and then there's managed risk. Recently, the bank reported a 16% quarter-over-quarter increase in provisioning for loans as borrowers face greater credit strain. At the same time, the structure of the renewals can also provide some confidence for investors. That's because management expects peak losses towards late 2024 and 2025, and only 14% and 25% of all Canadian mortgages at RBC will renew in those years, respectively. And we note that the bank can continue to build reserves over the next 2 years, especially if credit strain increases. Now, we'll admit that the rising mortgage risks have us leaning closer towards a medium uncertainty rating on bank stocks, but we're maintaining our exemplary capital allocation rating for RBC stock. Calculated risks like RBC's latest expansion into the U.S. high net worth and commercial banking space should provide additional high margin growth that bank investors look for, not to mention the change in risk when interest rates finally come back down. For Morningstar, I'm Andrew Willis.